All right, welcome back to the show. Today I've got Karl Schnitzer, who is, I guess you call him a salesman for whole life insurance. We're going to talk infinity banking, which is kind of all the same thing there. I want to learn more. I do have a policy, but I want to learn more. So, Karl, welcome to the show, man.
Hey, John. Happy to be here, man.
So, first off, what is life insurance? Because obviously there's two different kinds that I know of, term and whole life. So kind of explain that.
Yeah, so let's break it down as a, kind of big umbrella term. You have life insurance. Under that umbrella, you have term insurance, and then you have permanent life. Basically, term is for a term, 10, 15, 20, 30-year term policy. Permanent life is for your entire life. Permanent life is its own umbrella. Under that umbrella, there's whole life insurance, is just one product under the permanent life umbrella. Then there's index universal life, VULs, EULs, survivorship policies, all different products under the permanent life insurance umbrella. Pros and cons to each of them. The only product that we really deal with for infinite banking purposes is a whole life insurance policy, and even more specifically, they call it like a dividend paying whole life insurance policy. And we only structure these with mutually held insurance carriers. So then, kind of taking another step back, under the life insurance, carrier umbrella, there's two types of carriers. There's stock insurance carriers. There's mutually held insurance carriers. The difference is that a stock insurance company trades on the stock exchange. So stock investors can go buy, stock in them. These are all the, big commercial companies that you see. They're all stock held insurance companies. They have different lines: auto insurance, home insurance, life insurance, whatever you want to insure. They're all stock companies. If you think about it, what's their duty is to produce dividends for stockholders. Mm-hmm. On the other side, mutually held insurance companies, they don't trade publicly. So their shareholders essentially are the whole life or I should say the permanent life insurance holders of their insurance company. So again, they have a duty to their policy holders to produce profit. And because they're dividend paying, the profits that the insurance carrier makes goes back solely to the policy holders. There's no outside shareholders. And they actually have a fiduciary responsibility to their policy holders to produce income for them. And like I said, the dividends only go to policyholders. There's no outside stockholders. And when you really look at it too, like from the insurance kind of history space, some of these mutually held insurance, they've been around 150, 200 years. One of our main carriers that we work with, they've been around 177 years. Mm. And not only that, they've been profitable and paid a dividend consecutively every single year for that 170. It's like 1847. So I think it comes out to 177 years, but it's crazy when you think about it. I mean, there's not a lot of stock companies on the stock exchange that have that kind of history or that kind of dividend history of 150 plus years, making dividends to their policyholders or shareholders, whichever it is.
Sure.
Yeah. So that's kind of a breakdown of life insurance.
Yeah. And that makes sense. And some people probably have to re-listen to that or read up on it. I've read up on it and currently reading a book about it right now too. But the more you dive into it, the more it makes sense. I've had a term life policy since probably, I don't know, 15 years, probably close to it. That's more or less gambling, right?
Yes and no. I mean, so term has value to it.
Okay.
And we do term for the right client.
Okay.
Term, so statistically speaking, it's like 99.89% of term never pays out. So you pay an insurance premium, which is profit to the insurance carrier, which goes back to, us whole life holders. That being said, there still is value in term. There's kind of, I feel like everyone falls into two spaces when they look at life insurance. They either view it as an expense or they view it as an asset with value. And term definitely has its value, especially too when combined with, an infinite banking policy. The way that it's designed, it's mostly paid up additions rider, which does not go towards your death benefit. So the death benefit on these policies is fairly low. So if you need a high death benefit, having a cheap term policy or even some kind of convertible term policy can provide, significant value, especially, like me personally, I'm I'm a pretty low risk kind of investor in person, and I want to make sure my family and my wife is secure if something were to happen to me. So, if I wasn't fully insured with my whole life policies, I would look at convertible terms, and it works for some people. Like I said, it's not a one size fits all. I'm not here to say everybody needs term, and the odds of it ever paying out are very, very slim. So, it's unlike whole life is guaranteed to pay out. If you do your contractual duty, the insurance company does their contractual duty. Term, the last thing I'll say on it, when you look at term, they're essentially just betting on your life. So in a sense, it is kind of like gambling, where they have all the data of every single 30-year-old person, in my region that has, all the actuarial data they need to make a bet. And these actuaries are not stupid. They're very good at making that bet. They win that bet 99.89% of the time. So they're essentially saying, hey, this guy wants, $250,000 term policy. We'll make that bet for $1,200 a year or whatever the case is. And like I said, they're really good at making that bet. And when they scale that out over, tens of thousands of people, sure, they will pay some policies out, but overall, unless it's some kind of extreme, death that was unaccounted for, they're going to win. Which is, again, from a whole life standpoint, that's good. I want the insurance company to make money because it's increases our dividend.
Yeah. So why, obviously there's people out there like Dave Ramsey. Why do people bang on whole life so much? And especially Dave Ramsey, he's one I can think of that.
Yeah.
So he recommends term versus whole.
Yeah. What I'll say too, and I actually agree with like 95% or so of what Dave Ramsey says about insurance. And where I think the discrepancy is that when he talks negatively on whole life, he's looking at a retail base premium, whole life insurance policy that has no cash value for 7 to 10 years. It might break even in year 20, and it's going to have, just high premium with no cash value. An infinite banking policy is designed differently. It's only between 20 and 30% base premium. The rest is just what we call a PUA rider that you can put money into your cash value account. The other thing I'll say with Dave, and I like a lot of Dave's content. I think he's a great business person, a great salesman, and he has a brand and a message to sell. Yep. And his company sells term insurance and mutual funds. So he's going to, put that on a pedestal and kind of talk negatively towards everything else. And the other thing I'll just say too, so he has videos out there on infinite bank in particular, and so kind of background on me too. I'm a practitioner with the Nelson Nash Institute. So the Nelson Nash is a guy that, he didn't necessarily found or create infinite banking. People have been doing this for 200 years. He more so brought light to it in like the 80s, and kind of brought it down to like the common person. Because before that, it was only like ultra elite families utilizing the strategy. So, I've been through all the coursework. I've been through the Nelson Nash Institute. I have my practitioner cert. I understand it, through and through. The stuff that Dave says specifically about infinite banking is just completely unfactual, and that's where I think Dave kind of needs to stick in his lane of, okay, you're a stockbroker, you do mutual funds, whatever, else financial advice wise you do, insurance is probably not one of your strong suits because there's so many flaws in what you're saying. And there's response videos from all kinds of different insurance agents out there of Dave Ramsey's, approach, and like they'll show a clip. Hey, Dave just said this. Well, here's the facts, and even like the one I'm thinking of, he says something like banks don't use life insurance. That's just not true at all. You can type in BOLI on Google, type in bank-owned life insurance, type in anything. There's billions and billions and billions of dollars that
they're the largest consumer of life insurance, right?
Exactly. Yeah. They have billions of dollars. It's funny. I just switched banks to a new bank, local credit union here, and I was looking at their balance sheet, and like literally one of the things that sold me on it was the amount of life insurance they had. Because I'm like, all right, if we go into turmoil kind of times and tough times, and I don't trust banks to begin with, but I'm like, all right, these guys have sufficient life insurance and cash value in place, which I know is guaranteed. So, to me, that's a safe kind of aspect to look at it. But like I say, yeah, Dave, I agree with most of what he says. I think he takes a retail whole life insurance policy, which is like, that's the other thing too, just in the space, people hear this concept and then whatever they want to do with it, they'll go to, their brother-in-law at State Farm or something, be like, hey, I heard about this. Can you do this for me? And then they get a retail whole life policy and they're like, oh, well, this policy stinks. It's not growing cash value. I have no cash value, whatever the case is. And they're like, oh, infinite banking, doesn't work, blah, blah, blah. I'm like, well, you went to the wrong person. There's a very strategic way to design these policies. One, for that design, but then two, to grow tax free. Because it can be a very dangerous policy if you're putting a bunch of cash into it, and then at some point it can taxes on all of it. So, yeah, like I said, I mean,
Well, you bring up a good point of getting the right policy, and first you have to find the right person to help you, which I've dealt with two other people before, and both of them were selling the wrong policies I was looking for until I met you and you guided me in the right direction. So hopefully everyone that's listening that's interested will reach out to you. But if they don't, what should they look for when they're looking for a whole life policy that can be used for infinite banking?
Yeah, so that's a great question.
And explain what infinite banking is first.
Okay, let's answer the first one first. I think I'll go into it. So it's a good question because it happens so much of kind of people that were sold one thing and then they see a podcast or someone refers them to us. I'm like, yeah, this is, unfortunately, you had good intentions, but I think you could do better here. But the main other product line you see is index universal life, or any kind of universal life is kind of its own umbrella too, with IULs, VULs, EULs under that. And what I'll say with them, so first off, they don't have the history that whole life has. Whole life has been around 200 years. IUL started in the late 80s, early 90s. And if you research them enough, they were built, one, as a revenue stream to the insurance company, but two, prior to the 80s and 90s, and I mean, this is even before I was born, but 80s was, the average American, and you can look this up, this is just history, used to keep a lot of their savings in whole life insurance policies. It wasn't until the 401k was introduced when the average person could go out and buy, stocks and funds and all that kind of stuff. So in the 80s, and when the 401k was introduced, all this money now was flooding Wall Street and leaving the insurance company. So the insurance companies created a product line, which was these universal life policies, in order to get a hand on some of that capital that was leaving the insurance industry. That's how universal life was created. It does not have the track record, which is one of my, kind of things with, because if you just look online, there's so many agents selling IULs as infinite banking policies and stuff. It's a buzzword, so it sells. And I can tell you, as a Nelson Nash Institute certified practitioner, we do not use that. Anybody that says that is not an accredited practitioner with the Institute.
Well, and how do you know that you're getting put in the IUL? Because I didn't know. And even if I would have known, I didn't know what the difference was.
Yeah, I mean, then that's where kind of going into my second thing, the policy is one thing of how it's set up. The right guidance, the right coaching, the right firm is almost, if not equally important, more important than the policy. Policy is very important, don't get me wrong, but having the right guidance in place. And that's where, the Nelson Nash is a great institute where you can go on there, you can, find practitioner, and you can see by state. If you want someone local, you can choose someone local. Most agents are licensed in all 50 states, so you don't really have to go local. I mean, you and I aren't local, but I would say probably most of our clients too are all over the country. But going back to the one thing, so you said, what do you want to look for? There's a couple things. One, it's with a mutually held carrier. Very important to people with a mutual carrier. I mean, if you just look at the history of them, like the one I was saying with 150 years, and these are big names that have been around a long time. They've been through multiple world wars. They've been through, recessions, depressions, Great Depression. They've been through the Civil War, where we had two different currencies in existence, and they've managed to get through that and stay profitable. Some of these stock companies don't have it, and their I guess what we'll call their alignment could be out of whack from a mutually held carrier. They're trying to make their quarterly earnings reports for the stock exchange and all their thresholds they need to meet. Mutually held carriers do their own thing. They don't have these Wall Street incentivized thresholds they have to meet to where just do the best for the client. So the first thing, mutually held carrier. Second, dividend paying whole life insurance. You want to make sure the policy is non-MEC. What that means is MEC is just MEC. It stands for Modified Endowment Contract. if a insurance policy ever turns into a mech, it's a taxable event, and you would owe taxes on all that money. So you want to make sure that this policy will non-mech. And the other thing I'll point out on that is a policy can illustrate a non-mech, and like a lot of these IULs can illustrate non-mech. But if something happens within that policy, which is one of the reasons we don't use these IULs, is because all the guarantees of why we love life insurance are essentially out the window. And if something happens within that policy, just because when you were sold the policy, it illustrated a non-mech, that doesn't mean it won't ever mech. It still could mech. So it could be, dangerous from that aspect. And then I would say too, just the right kind of guidance and the right, coach and insurance agent that's going to walk you through it, help you out. Even like, there's so many firms out there, good firms, great, there's awesome firms out there. There's also bad firms out there. I hear it in the industry that there's firms out there, they may run so many Facebook ads, they have 15, 20,000 clients, and you're just a number to them to where you're never going to get a hold of your agent. You may get sold a policy and then that's kind of it. So personally, and I mean, it's also our firm, but I prefer working with like a smaller kind of boutique firm that doesn't have 10, 15, 20,000 clients. At that point, it's a big kind of commercially run business. It's not like a mom and pop insurance shop. So the relationship is just better on smaller firms.
Yeah.
The last thing I'll say,
explain everything, like all the misconceptions about whole life, right? That you hear people complain about. You just explain why people complain, because they're putting the wrong products, they're with the wrong carrier, just all that combined, and they're going to have bad experiences. You've got to be with the right carrier.
Yeah, no, and that's exactly it. The wrong products, wrong carrier, wrong person, wrong kind of like advice on how to use the policies. And there's some absolutely dangerous advice out there that I see on social media that I would never tell a client to do or anything. But and that's where honestly referrals is a good way to find somebody, because it can be hard. And I would say too, like we always say, we eat our own cooking, where the agent that is selling you this policy and this concept, you want to make sure they're doing the same thing too, and that's where it's like, I would never buy something from someone or take advice from someone that, isn't doing it themselves or anything like that, if you know what I mean. So, that's an important thing to look for when you're choosing, kind of an agent to work with, because it's a long-term relationship. If you, really dive into this, the infinite banking and whole life insurance is a lifelong and really multi-generational strategy. So you're going to have a very kind of like intimate relationship with your agent, where they know a lot about your finances, they know a lot about your family, and you're always, once you kind of get into the swing of things, like you're not just getting one policy and done. For the most part, people policy stack and keep adding policies as their income and their value grows to the marketplace. So finding that kind of right agent that you just have a good vibe with is important. And then you just kind of look at like what all they offer too. I mean, there's some firms that they get a policy and you might get a Christmas card once a year. And then, like one thing that we kind of do for clients is we have an entire online educational space where clients have access to all of the owner of the firm. I don't own the firm. The owner of the firm has an entire library of resources, of videos, of books, of all kinds of different stuff. He's got a lot in the works of kind of expanding that too, so it's going to get even better. But there's probably, I don't know, 20, 30 hours worth of content on there of like, hey, here's life insurance resources, here's family banking resources, here's estate planning resources, here's my estate attorney, here's my CPA that I use, here's everything, and just kind of building that resource for the client of kind of being that, like, I wouldn't call it a one-stop shop, but like a place to go for resources that you can trust. Because once you get into the YouTube and Google rabbit hole, great content on there, also probably not great and maybe half illegal content on there.
Yep, for sure. So on a third grade level, explain what infinity banking is.
So it's a very hard topic to on a podcast setting. It's easier with visual. Yeah, well, it's easier with visuals and stuff. But so on a third grade level, let's just look at, when you look at a bank, what do you use a bank for? Most people use it for deposits and loans. You're going to put money in there. You're going to store and warehouse your money there. And then if you need a loan, you go to a bank. It can be a credit institution, whatever the case is. But the two main functions of a bank are that you deposit money and you warehouse money there, and then you borrow money. When you look at the banking function of your life, those are two things you always have to do. You can't operate in society without those two things. Everything else, for the most part, is optional, but the banking function of your life is not optional. Unless you're, living in Alaska off grid and don't need a bank and trade, seeds and stuff. I don't know, but everyone needs to have that kind of banking function. So when you're looking at the banking function now, there's only three types of ways that anybody can spend money. The first way is by using cash. So if you use cash and you just, you got 20 grand in the bank and you take 20 grand and you go buy a car, the problem with that of using cash, and it's good in some scenarios, it's, again, there's no one size fits all for everybody, but when you take money and you spend it in cash, you lose the opportunity cost of that cash forever. If you take 20K and you go buy a liability, that 20K is gone. It's not working for you anymore. It's not gaining you interest. It's not working for your kids or your estate. It's gone. The second way is you borrow money. So if you take a loan, from a bank and then go make the purchase, this is good, especially in low interest environments. I'm not opposed to using OPM, which is kind of a lot of like the infinite banking practitioners like, oh no, you never use a bank. And I'm like, hey, money's 3% and I can earn more, why wouldn't I? But so if you borrow money, the issue with that is that, one, you're paying interest to a third party that's not owned or operated by you. And then two, you're losing the opportunity cost of, again, the money going to make that payment. The third way is that you can use an asset as collateral that's going to appreciate, borrow against it, and make the purchase. That way that the asset is still continuing to grow and you have liquidity from the asset to go make the purchase. Now, you do pay interest on that loan. However, from a long-term perspective, and when you really scale it out, as long as what your asset is appreciating and growing and compounding is greater than the amortized interest that you pay on the loan, the interest that you pay, could not only be a wash, but you would actually have a gain too. There's trying to think of the numbers in the one presentation that I have. It's like if you borrow $50,000 and you pay it back amortized interest, you pay $46,000 of interest at 6% over a 25-year period. Is that scenario? 50K borrowed at 6% over 25 years, amortized interest, you pay $46,000 in interest. Mm-hmm. If you have that same 50,000 growing at 6% uninterrupted compound interest, it grows like $146,000 of interest. So now you're left with a spread. You paid 46 in interest, you gained 146 of interest. You're net positive. And what we're trying to do, with the policy and a series of these policies is take back the banking function of deposits and loans, and then self kind of finance our own purchases. Every single purchase you make is financed, and that's one of the first. It's one of the first slides I have in a couple of our presentations, because when you start thinking like an economist, every single purchase you make is financed, whether you want to agree with that or not. It's true, and any economist will tell you that. Whether you're spending cash, there's an opportunity cost to that of everything, no matter what you're buying, asset or liability. So when you kind of start making purchases with that mind frame or mindset of, hey, every purchase I make is financed, you and your family want to be the financier of that purchase and recapture that interest that you're paying, or recapture that interest that you're losing in opportunity cost. That's the whole idea of, so that's kind of infinite banking. Now, how does whole life relate to that? So whole life, we've already kind of talked about the history and the strength of the asset and the product. Whole life insurance, if it's designed correctly, it's going to have a death benefit. It is life insurance at the end of the day, but it can have a cash value component to it. Your cash value is very unique, and it's really cool. And I mean, I'm an insurance nerd, so I think it's cool. But that cash value grows uninterrupted compound interest, which is very important. If you ever, let's take a side note. So there's a difference between compound interest interrupted and uninterrupted compounding. And when you look at most, like, I'm not fully opposed to qualified plans. Some of them I don't think they fit in a lot of scenarios, but what I'm getting at is if you look at like any kind of stock insurance, stock investment accounts or any kind of like qualified plans, again, I'm not opposed to them. I think they're for the right person. But they grow they grow interrupted compound interest. So if you look at a 30, 40-year history of like, an 401k or any kind of investment account or any asset, really, could be real estate too. If it has ups and downs, it's interrupted. Every time you interrupt the growth or the compounding of an asset, doesn't matter what it is, it takes a higher gain to break even from that loss.
Yep.
So a lot of people, they have, compound interest is like this buzzword people throw around. Everyone says, oh, they're growing compound interest and blah, blah, blah. I'm like, are you though? Because, last I checked, the market was down and after COVID, the market crashed in '08, like over these, 10-year cycles, I think it's pretty clear that there is a correction in the market. And again, I'm not opposed to it at all. I'm just, calling, balls and strikes to where it's not actually compounding if you interrupt the compounding. So, in my personal kind of like growth mindset, investment philosophy is I like things, or at least like to have a bucket in my overall portfolio that has uninterrupted compounding. So then going back to that cash value, your cash value is paid guaranteed interest every single year. Plus you get a dividend. The dividend is not guaranteed with these carriers, only the interest is. However, I'd say of the big 5 mutually held carriers, maybe a little bit more, 7 of them, they haven't missed a dividend in like 150 years. So it's very likely they'll pay a dividend. But even if they don't pay a dividend, which would be like, if that happens, there's more issues in the economy than that. But you're always going to get your guaranteed interest. So you're growing uninterrupted compounding without ever suffering a loss. The other cool parts of it. So cash value, depending on your state, in most states it is, but you just, can talk to an attorney and check out your state. It's creditor and litigation, protected. So even if, if you're a landlord, a lawsuit could always be a risk. We live in the most litigious country in the world. If, you ever have any risks of lawsuits, your cash value can be a protected asset that can't be, touched. Again, if you're in the correct states for it. And it's most states, just not your, far left ones. But the other cool thing, so as a policy holder, you have a contractual right to access the general fund of the insurance company, up to it's 90 to 95% of the value of your cash value. So you're putting your cash value up as collateral and you're taking a loan from the general fund of the insurance carrier. So this is, the other thing on social media, everyone says, oh, you borrow from yourself. It's not technically true because you're borrowing from the insurance company. Your cash value is just being used as collateral. So for easy numbers, let's say you have 100 grand in cash value. If it's a seasoned policy, you can probably get like 95 available. It kind of grows every single year by year 3 or 4. So it starts at 90%, then it'll grow to like 95. It operates just like a line of credit. You can draw down on it, use it however you want. When you use it though, so back to that scenario, say you have 100 grand of cash value, you borrow 95 to go put down on, storage unit, real estate, whatever it is, buy the whole thing outright, private lend, whatever your, or it could be to buy liability. You're not interrupting the compounding because the 100K is still going to get the guaranteed interest inside the policy. Yep. So now you have 100K working inside the policy. And if you use that 90 or 95 to invest into an asset, you're getting 90 to 95 working for you outside of the policy. And when you, scale this out over 20, 30, 40, 50 years, and then pass this strategy on to the next generation, it can be extremely, powerful. And when you really kind of like study some of the wealthiest families, this is a part of every family office is having, a life insurance, a strategically, we call it like an advanced planning life insurance agent, that builds these policies for families. And you can look back at some of the, even like, I may disagree with him, but one thing I agree with our sitting president is that he has 6 whole life insurance policies with Mass Mutual, and that's, that was in his disclosure you can see online of assets and stuff. He even says he owns no stocks or bonds, but he has 6 whole life policies with Mass Mutual.
Yep. So let's keep going with that example. The $100,000. Let's just say it's a single family rental house. It's we'll just say it's 90,000, right? To purchase. You got $100,000 in your policy, so you borrow $90,000 to buy this house. How does that look? What do returns look like? Dividends? What's your payback look like? All that stuff. We'll just say like over a course of like 5 years.
Okay. So dividends across the industry, usually anywhere from 5 to 6%. There's been years when it's been higher. There's been years when it's been lower. But usually about, like our main carrier is 5.75%. And I heard word that they're going to increase it. But anyway, the guaranteed interest of policies is usually between 3 and 4%. Dividend is, on top of that. I'm sorry, not on top of that. It's combined. Like you'll have a 3 or 4% guarantee, and then whatever the dividend is, you'll get that extra spread. So you'll get that
between 8-9%.
No. Total,
No.
whatever the dividend is, you're just guaranteed to never go under
Gotcha.
3 or 4, whatever the policy and the carrier, feature is. So you're going to get that inside the policy. The internal rate of return of most policies in the industry, again, there's different carriers, different features, different health and risk class and age, but usually between 3 to 5% internal rate. So looking over an entire lifetime, the loan that you take to buy the single family or whatever you're doing, that's going to perform just like it would. There's kind of 2 ways you can look at it, and neither way is wrong or right. It depends on the investor's, investor DNA. But some people would just buy it 90 and then pay back, their mortgage to the policy. Other people would, do the buy, the renovation, and then refi it out with a bank, pay back their policy loan, do it all again. Again, neither way is wrong or right. I was doing like the burst strategy for a while with my policies, and now I don't really want bank debt right now. It's just not in my kind of investor DNA in this economy right now, but nothing wrong with it if that's what you want to do. But there's kind of 2 ways to do it. So the cash is going to grow no matter how you use it. Again, if that would have came from, 90,000 in a cash, in a checking account, there's opportunity cost to it. Even though you're buying an asset, you're still having a lifetime or a legacy opportunity cost to that capital. You finance everything you buy. The other thing I'll say too, on the inside of the policy, a lot of people, and this is something I disagree with in the industry, and I think I personally see it more in the IUL space, but people sell life insurance as an investment, and I don't think it should be sold as that. Life insurance is a savings vehicle, and that's where, one thing that I've learned over the years from the mentors that I have and everything, there's a difference between savings, investing, speculating, and gambling. Savings is going to be your low risk, guaranteed growth, capital's there when you need it. That's your savings bucket. Reserves, opportunity fund, emergency fund, whatever it is, you wouldn't put your savings into like, maybe some people would, but Bitcoin or, Dogecoin or whatever those ones are. But you need a safe bucket. That's where the whole life fits in, because a lot of people say like, 4, 5, 6%. Why would I do that when I could put it in the market at 8, 9%, or real estate at 15, 20, whatever the case is? And I kind of have, 2 responses to that. One is, why not do both? And if you read Becoming Your Own Banker, I think it's page 69, it says, but I can get a higher return. And he addresses how you can't. If you don't factor in the banking function of your life. And in that example, he compares using a checking account to buy an asset versus using whole life to buy an asset. And he shows you, if you don't factor in the banking function, the opportunity cost of capital, you're actually making less by going from, checking to investment, as opposed to going from whole life insurance to your investment and collateralizing it, because you're getting the double growth of inside the policy and then outside the policy, which you are paying interest on that. But again, from a macro point of view, compounding, and you're paying amortized interest on the loan. I was going to say one more thing there. I don't know, but does that answer, how it kind of works?
Yeah.
And the one thing I'll point out with policy loans, easiest loan you'll ever get. There's no credit check. There's no reason for the loan. There's no, income verification. Again, you contractually have a right to access the general fund as a policyholder. So I don't think, if you take policy loan, like it's literally your policy number, how much money do you want? Where do you want to wire to? Sign and date, 5 days maybe, and you get a wire to your account.
Yep. So you've taken that 90K out. You're still earning interest on the
full
money
amount
that you've put in there. Yeah, that you've pulled out. Yeah.
Yep.
And your monthly payments can be basically anything, correct?
Yeah.
And you don't have to pay back. There's no timeline that you have to pay it back. Is that correct?
Correct. So the payment schedule is up to you. Like I said, there is interest on the loan that will accrue, but the payments, like I'll give you an example. We just bought, the house that we're living in and took a policy loan, and, we didn't make any payments on that policy loan when we bought this house until, we just applied to refi it and now pay back our policy loan. So could we have made payments on it? Yeah. And do people do that? Yeah. There's kind of two different ways that, like, some people are under the mindset, hey, I should put every single dollar I have like into policies, and one, that's not possible. So people online saying that, again, you can't legally do that. But so when you're pulling a policy loan, the payments, yeah, they can be, you can do them quarterly, monthly, you can do them annually. You can not do any at all if you don't want to. It's really kind of up to you. And there's two ways to kind of look at it. Like if I'm borrowing, for, it's an example, like if I'm borrowing for a car, I may just make, car payments back to my policy every month, just like I would anyway. However, if I get a windfall from a property I sell, or, an exit from something I'm involved in, whatever the case is, if I have, a large sum of money sitting in my bank account that just came in and I have an outstanding loan over here, I'm just going to pay the loan off. I literally look at it as, another savings vehicle, just like it's sitting in a bank, that it's going to be sitting available again whenever I need it inside my policies. So, there's, like, I haven't done flips in a while, but when I was doing a, flip or two, I wouldn't make any payments on the policy loan. So I would draw a policy loan. I was kind of combining it with private money at the time too. So I was just using it to fund my kind of bridge funding of down payment, renovation, whatever I needed. And then wouldn't make any payments on the policy loan until the house sold, paid it back in full. We paid for, like, it's another example, like my wife's grad school. We made payments on that. We took a policy loan, paid for grad school, and then just made payments just like a student loan. And then if and when our, checking account, was up to an uncomfortable amount, personally, I don't like to keep money in the bank, but I'll just take that and put it right back in our, series of policies. And again, it's available if I need it. It's just, to me, I look at it just as my savings vehicle. In an entire portfolio, you have your safe assets, you have your, maybe mid-risk and your high-risk assets. To me, this is just my safe bucket of where I store my liquidity and my capital.
Yep. No, for sure. This has been a ton of great information. I've got one more question, and that's, so you can either bring a chunk of money and put in a policy one time, or you can basically put money in yearly. Is that correct? Or are there other options?
Yes and no. So to avoid that MEC limit we talked about earlier, you have to pay into a policy for a minimum of 7 years. The part of whatever the IRS rules are around insurance, they require the premium to be made for 7 years. That premium can be lump summed. However, it doesn't go all into the policy all at once. This is kind of more of like an advanced strategy, great strategy for someone with like a business exit coming up, or selling a property, selling a business, whatever the case is. If you come into a lump sum of money, something like whatever the case, whatever's a large amount to you, especially anything over 250, like personally, I'm not putting anything that's not FDIC insured in the bank, and I don't even trust the FDIC, but they admitted they only have 3% of whatever they insure. Like, come on.
Yep.
But anyway, so you can lump sum a policy. However, not all of the dollars go into the policy itself. The way that would be structured, we call this a lump sum LILOC strategy, where, let's just say, like, I'm thinking of someone right now, say you have $1 million exit. You can't just put $1 million into an insurance policy. It'll instantly trigger a MEC. You'll owe taxes on the growth of it. We don't want to do that. What you can do is spread that $1 million out over, 7 years, but give the insurance company the 1 million at once. So the way that the insurance company would separate it is that they would put, a large amount into your premium deposit fund, which is essentially it's like a guaranteed interest account, savings account with the insurance company, as opposed to a bank. You pay guaranteed interest and money just sits there. The only thing that money can do is pay your insurance premium as it comes due. So
Gotcha.
you would wire $1 million to the insurance company. They would pay your first premium as it comes due. This is going to be growing interest. The policy will be growing interest, and then year 2 premium comes around. They draw from the account, pay year 2, year 3, so and so until the account's exhausted. What's
And
really
that's
cool
just
about
10 years.
that, yeah, you can structure it 7 or 10
So
years,
it's a
sometimes
million
10 years.
divided by 7 is your
Yes,
yearly
but
payment.
it would actually be more because you're getting credited the interest of the PDF. So like on that $1 million example, the person that I'm thinking of was $1 million spread out over 10 years, and it actually allowed them 125,000 a year premium into the policy because of the interest the PDF, the premium deposit fund, was accruing.
Gotcha.
What's really cool
Okay.
about that strategy, which is new as of 2024 and this year, this past spring, they changed some rules and laws around your PDF, the premium deposit fund, used to not be allowed to be have a collateral assignment. Now it can be. So what you can do is get a line of credit, like a LILOC, a life insurance line of credit. Most, maybe not most banks, but there's banks out there that offer it. You can get a LILOC secured by your cash value inside the policy and also your premium deposit fund, to where we ran it out for a client that we're working with, and it's like year 1. Well, it was like 30 days later, after they wire the money, they could get a LILOC for, it's like 93% or something like that of their $1 million at 930 grand as a line of credit to use for whatever, while they're getting interest in the PDF, interest in the premium or the policy. And then by the end of year 1, it goes up to like 98%. And then by the end of year 2, it's over 100%. So 24 months, you basically still have access to all your capital, and you're getting all the benefits of life insurance. And the other thing we didn't even touch on too is a death benefit,
Yep.
of the death benefit, especially if you are doing any kind of advanced planning of like any kind of waterfall or like windfall methods to the next generation. Huge opportunity with that, when you can still have access to the money. You can get all those benefits and still have access to the money.
It's awesome.
So yeah, to answer your original question though, you can lump sum it. It wouldn't go straight into the policy.
Yep.
It would be separated between those two accounts. But other than that, a normal policy that we would kind of set up for most people, we'll structure it to be paid out usually over a long time. Doesn't mean it has to be, but like we'll pay it out until age 65, age 70. Again, doesn't mean you have to, but you have the ability to. So
Yep.
Statistically, your highest income earning years are going to be later in life. That's when you're going to have, maybe selling properties, selling, business ownerships, whatever kind of windfalls maybe you get, any kind of inheritances or anything. But you want to have that open line available to put more cash into as those windfalls come in.
Awesome, man. Ton of great information. I'm sure people will have questions or want to reach out to you to open some policies. So where can people find you?
So our website's Producers Wealth. You can go direct to the website. There's a form on there. How did you hear about us? You can put Karl. You can put John. Either way, it'll get to me eventually. So that's one way. You can share my email in the show notes, and we can just set up a call directly. What I usually kind of tell people, we'll send out a form, and we'll do like a whole consultation. There's no charge for a consultation. We'll just that's the other thing too, is on our consultations, we'll see if it's a good fit for you.
Yep.
Infinite banking is not a good fit for everybody.
Right.
It's a great fit for a lot of people, but that doesn't mean it's good for everybody. And there's people we say like, hey, I don't think, putting 10 grand into a whole life insurance policy right now is the best thing for you. Do this or that, and then maybe come back to us in a year or two. And it might be a better fit. But yeah, everyone's different. So we'll just kind of have that consultation and see if it's a good fit for you. If it is, how would it benefit you? How would it benefit your family? Kind of go from there.
Awesome, man. Well, this has been great information. I learn more every time I hear you talk, and I learn a little bit more about this, because it can be complex because there's so many moving pieces, but definitely appreciate you coming on, man.
Yeah, man, no problem. Definitely, it can be complex, and there's a lot of noise in the financial industry around
for sure
whole life insurance. So
for sure.
Thanks for having me
Awesome.
on, John.
Yeah. Appreciate you guys listening. See you next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.